Stocks gaining back some momentum after a sluggish April. All three major averages are in the green this morning, with the S&P 500 index looking to extend a three-day winning streak. And while investors are broadly bullish on equities, it may be time to add some alternative investments into your portfolio. The alts. Our next guest thinks there are some key reasons why investors should be narrowing in on private markets, especially when it comes to real estate and credit. For more, I'm joined by the man you see right there, Miguel Sosa, Bluerock Head of Market Research and Strategy. Thanks so much for taking the time here with us in the studio.
Thank you, Brad.
Absolutely. So let's dive right into this. I mean, where, especially within the private markets right now and private real estate, should investors be looking for additional alts opportunities?
Sure. So we at Bluerock like private real estate specifically. The sectors that we like there are the industrial sector, the specialty sector, and the multifamily sector. And in that order, industrial really is driven by online commerce. More people are buying more products online and they want it at their homes faster. So that's driving demand. At the same time, people don't want the warehouses where those boxes sit close to their homes. So that's limiting supply of industrial warehouses. It's ideal for those warehouses to be close to the homes. So what that does is drive up the lease rates for the industrial space. Now, for the specialty sector, we like the specialty sector because it's such a unique space that's not too correlated to the economic cycle. So for example, if you think of data centers, data centers sit in the specialty sector, and if the economy is doing well, people are going to consume social media content on their phones or on their computer. If the economy is weak, they're going to consume social media content on their phones or on their computer. So it's very resistant to economic cycles.
What are the hottest regions for private real estate right now?
Hottest regions, we're seeing for the multifamily sector, for example, we're seeing a lot of growth in the Sun Belt region of the US. So that's where demographics are in favor, acting as structural tailwinds. So in essence, people are moving from the Northeast, from California, from areas that are really expensive. They want to raise a family. They want to be in areas that the cost of living is lower, taxes might be lower. So we're seeing significant growth there, and that's where our investment thesis is.
What about the interest rate knock-on effect for some of the real estate investments and private real estate investments right now? How is that moderating decision-making around those investments too?
Sure, so it plays itself a little bit differently depending on the sector. For multifamily or apartments, even single-family rentals, it's actually increasing demand for those rentals because people, even those that want to buy homes, can't buy homes. They have to defer, they have to wait to purchase, and so that's driving demand for rentals. In the industrial space, demand for that space is so strong, lease rates are up, occupancy rates are really high. So even if financing costs are high, there's still more than enough revenue to be able to service that financing debt.
Is there like a good rule of thumb or benchmark return that you should be looking for with an investment like this versus, say, the equity market if you're just buying the S&P 500, for instance?
Sure. So probably the most commonly quoted metric within real estate is cap rate. And cap rate, very simply, is the approximate lease rate that a real estate property will generate over the market value. So cap rates have moved up, given interest rates have moved up. Investors are looking for a risk premium. Cap rates will really depend by sector. They may vary from anywhere from 5% to 6% for healthy-ish sectors such as industrial, upwards to 8, 9% for something like the office sector, which is down significantly in valuations, driving up cap rates. So that, though, hides the fact that real estate can appreciate in value as well.
Do you see, and you mentioned the office part of that, do you see office sector portion of this making the same type of comeback that we've seen in other industries needing to make post-pandemic, especially considering the shift in where people are working right now?
It's hard.
Yeah.
It's really hard. We're not invested in office. We think it certainly went through some challenges during the pandemic. Return to work didn't really play out as investors expected. Occupancy rates are really low, lease rates are going down, and so it's going to be some time before we see some healthiness or robustness in that sector.
Miguel, excellent insights. Thanks so much for breaking this down for us. Miguel Sosa, who is the Bluerock Head of Market Research and Strategy. Appreciate it.
Thank you.